Hi, Amber. How's it going?
Hi, great. How are you, Sarah?
Doing great. Hanging out in this 110 or whatever heat. Well, you're off being awesome anyway. Just saying.
I just had to escape the inferno for a little bit.
Oh, good for you. Good for you. So, and just speaking of, kind of what you just think about, what do we get used to? And people ask, do you ever get used to this heat? And I'm kind of like, no.
Well,
But it's you think about like what is kind of in big deal is what people can get used to. And like you think about even in relating it to real estate, like you think about we've gotten used to this just crazy low inventory, crazy amounts of pressure, crazy, like all of your buyers saying, oh, we got to write 64 offers first. And, it's like you get used to it, but that's not healthy.
right.
Sometimes I kind of like to, let's talk about where we should be, what's going on, and not just kind of like the insanity of it, but also what's happening behind it.
Yeah.
And, so our market actually peaked in March. We had like so much intensity. We got so used to it. We had like 17 houses on the market. And then, as we reached March, that kind of peaked out. And we've actually had some demand declines and some inventory increases, which are good. So, you want to remember this is a good thing. In the past 3 weeks, our inventory has actually increased by 13%, which is, it's a significant increase. And we're only up to 5,800 active listings. That is, we should be at like 25,000. So just to kind of for perspective, and demand is still roughly about 7% above normal. So, demand is still definitely increasing, supply is increasing, demand is decreasing, but it's moving in healthier directions both ways. And you think about it, like the appreciation rate right now, we're over 30%. 18 months ago, the idea of a 10% appreciation rate in a year was excessively high. So again, we got used to it, you think about the relationship. So in 2005, the supply and demand relationship was that we had crazy high demand. Today, our supply and demand relationship is really based on very, very low inventory rates and healthy demand, but we don't have crazy excessive demand. Today's buyers, and Amber can definitely talk on this more of, today's buyers are more qualified. They have better paychecks and, or at least can prove it because it's not the no doc loans or anything like that anymore. But, these are buyers that can looking to live in these houses. Want to just touch on that appreciation rate really quick, and that and according to a recent report from CoreLogic, in Q1 of 2021, homeowners gained $1.9 trillion in equity, which is a year-over-year increase of like 19.6%. And then you look at it, and that breaks down nationwide for every borrower in the country, they gained $33,400 of equity. In Phoenix, and I will post this, or share the link to this image, but I have a picture. In Arizona, we gained $51,000 in equity. That's huge just for 3 months, in a short quarter. We've seen, more and more sellers are coming to list their property. The increased competition is slowing down the appreciation rate, and it will allow more buyers to enter the market. All these things are good. Now is not the time to overprice a listing, because we are seeing some prices, or, some more price reductions. Those are definitely increasing. I just want to touch on a couple other things really quick, and just, mention that NAR actually put together a report and said that given the just slow building we've done over the last 30 years and the, kind of houses that have been, condemned and destroyed over the years, we're down about 6.8 million housing units. We need 6.8 million houses more for all the demand that we have of, for homeowners or homeownership. That would take about 2 million new builds every year for the next 10 years to make up for that shortfall. And NAR is talking about, it's calling on builders saying, hey, we really need your help in increasing building. But the challenge there is builders build for, they are for-profit businesses. And so it would probably require some government assistance to get to these levels that NAR is calling for. And last thing I just want to kind of touch on that I thought was really interesting is the Habitat for Humanity is actually building a 3D or printing a 3D house, and it just for the first one ever, happens to be in Tempe. And the goal is to expedite building process and of course, reduce some labor costs. So they're thinking about 70% of that building is going to be printed, while 30% is built through kind of traditional building. And it is expected that the family will move in this fall, and it'll be about a 1,600 square foot house with 3 bedrooms and 2 baths. And I think it'll be super cool to see. So with that being said, Amber, let's talk about lending and the Fed and FHA and everything else. There's lots going on.
That is super cool about that 3D house. And it's neat that it's empty. So maybe we'll be able to check it out. But I still can't get my head wrapped around how that works. But anyway, so a couple updates. Last week, the Federal Reserve held their meeting, and on Wednesday, we got the announcement from that, and the market moved significantly from that announcement. Prior to the Fed meeting, we've seen some hotter inflation numbers that were anticipated. So showing signs of high inflation. Inflation is the arch enemy of bonds or interest rates. Typically, high inflation is going to cause interest rates to go up. It seems though the market has been expecting these higher inflation rates, though, just because of all of the stimulus and what's been going on with the economy. And some of the analysts that I watch think we've peaked, that we're not going to see the inflation numbers continue to go up. But when the market heard the Fed talking about inflation being hotter than they wanted, they instantly went to, they're going to start tapering sooner than later. Inflation's going to continue to rise. The bond market got crushed on Wednesday of last week. We went up about 1/4 to 0.375% in interest rate in just that afternoon. Calm down a little bit, but we're still up about 1/8 to 1/4% in rate from before the Fed meeting. Likely people will continue to calm down. We'll see interest rates go back to where they were, but we're also going to want to see inflation coming down in some of these reports next month. So keep an eye on that. And then also we got great news in regards to FHA and how we have to count student loan payments against our clients. Student loans can just be burying our borrowers in their debt to income ratios, especially for FHA, because currently we have to hit them for the greater of the payment on the credit report, assuming that it's a fully amortized payment. So no like income-based repayment, or 1% of the outstanding balance. Now, effective August 16th, we're able to either use the payment on the credit report as long as it's not 0, or 0.5% of the outstanding balance. So that's going to help our FHA buyers be able to qualify. Now, it's not going to help them necessarily win an offer, but it's going to help them to qualify for a house or more than they had before. So if you have any buyers that are out there shopping, make sure they're getting their pre-approval updated if they have student loan debt and they're needing to qualify for a little bit more, because they are going to get a boost after these guideline changes. If you have any questions about it, let me know, but it's really good news because I see it every day, the amount of student loan debt just making these poor FHA buyers unable to qualify for anything. So great news there.
Awesome. Awesome. Are you seeing things, offers being accepted any more readily than before? Are you, what are you seeing with your buyers?
What I'm seeing is that those really well qualified buyers, the ones that have the money to waive appraisal contingency or to make up a large gap or have the large down payments, I feel like they're having a slightly easier time getting offers accepted, but still the buyers that no money, minimum down payments, not able to make up appraisal gaps, still really struggling. There's just so many buyers offering better packages, better offers than they are. So we're still getting super creative though. We're submitting our clients into underwriting beforehand. We're trying to help them do short closes. We're strategizing with them in regards to making up appraisal gaps, trying to give them the biggest unfair advantage that we can.
I love it. I love it. That's awesome. Well, Amber, thanks as always. I really appreciate your insight, and just feedback of what you're seeing and what's happening and how that helps, our buyers out there. Because the one thing is we need our buyers. We need our buyers to continue to be coming in and getting offers accepted, because without them, the whole machine stops.
Yes. So let's stay positive about it. It is challenging, but remember that we get to do this. And we are going to continue to go out there and fight for our clients and be with them. As long as they're in it, we're in it, and we'll get through it.
I love it. I love it. Awesome. Well, thank you as always, Amber. And I look forward to seeing you again soon.
You too. Bye, Sarah.
Bye.